if you look at past market cycles, market uncertainty is nothing new, right? And even if, you're not someone who's looking at precedents on the index level tick by tick as your roadmap, you can look at, okay, how did you handle past markets when there was uncertainty, and what did you learn from it? So you actually have a really great lesson, Scott, from the late 1990s that's on this sort of topic.
Yeah, it would be the Asian financial crisis. I guess we always use that word crisis. At least in my career, that's been the key word. And that would be like in the September to October period. A lot of Asian currencies were devaluing. The Russian ruble issue, where the Russian debt, they defaulted on the debt, long-term capital, and all of that is going on in this time period. And the market acted very poorly. You could see it got hit really hard in August, tried to rally, and a lot like today, look at it, it rallied almost to like the perfect spot where it should stop, from 1470 set right there. And then the next one is even better. So you get a really good rally
Right.
that
Because
stops
now we're
right
below
at
the 200
at
day.
the moving averages. Yeah.
Mhm.
And then you had a waterfall decline, and the news is bad at that point. And then all of a sudden, out of nowhere, the market just kind of, for lack of a better term, changes its mind. And you have to be willing to change your mind if you're bearish or neutral or out of stocks, or you might get left in the dust. And I do remember this period because I was convinced that this was going to be the big bear market that the market was due for, because we'd been, since the 87 crash, the market, there had been maybe a bear market in 94, but it was very short lived.
Mm.
There had been a really good bull market for a long, long time. And, the Greenspan irrational exuberant speech was years before. So everybody kind of knew the market was, it was a little bit, for lack of a better term, overvalued. And so I kind of had it in my mind that, okay, this is the bear market that's coming. And so I was unprepared for that snapback, and it took me a while to get back in. I know I was telling you earlier, I remember in that time period is when AOL and Schwab broke out, and those were two stocks that I didn't own because I was bearish. I thought the market was going to go down. So I didn't really see that signal. Look at that. And that's when, like, Bill O'Neill, the founder of IBD, was,
Yeah.
all over that year.
Right. And then what makes this tricky is then, you could rationalize, oh, well, the market's been so strong, it's got to pull back. It's got to rest at some point, right? Instead of incrementally adding exposure when you do get those signals, again, whether it's on the index level or leaders breaking out, right? If you don't act, it makes it a lot harder to get properly positioned later.
Yes, the first step is the easiest step. Just take one step. Just buy a 5% position. And I didn't do that back then. That's something we hear about a lot now in house and on that, where that, if there's a fall through day in the market, buy one stock, buy something. I didn't have that kind of rule or mentality back then. So, but once you get some exposure, then it's easy to get feedback. Like if I were to buy Schwab and Schwab's going up almost every day, I might say, boy, I probably should buy more Schwab, or maybe I should buy XYZ or ABC. And the market will just pull you in. But it's always that kind of first step. And the easiest way to, if you have a hard time doing that, I think, is just do the math.
Right.
If you just put 10% of your portfolio into the market,
yeah, what are you
and
risking?
let's say the market turns on a dime and you just bought the absolute high and it goes down 10% the very next day. Well, what is 10% of 10% portfolio? You lost 1% of your whole portfolio. You have to think I can survive that. I can overcome that with the next try and the next try. So that helps. It helps you, and it definitely helps me to get in. I'm big on incremental. I'm probably too big on it. I do a lot of incremental. Yeah, incremental in, incremental out, constantly balancing, with trimming here, adding there, et cetera, et cetera. And honestly, I do too much of it, but I would think my instinct is based on talking to lots of people when we used to go on the road, and is most people are kind of have the opposite problem. They don't
Yeah.
they don't do enough of that.
Right. And I think it helps so much with the mindset. So this was something I think I was talking about or alluding to a little bit earlier, that if you are able to make those incremental decisions, say you are super bullish, we're in a power trend, you're super bullish, but you start seeing some signs of weakness, whether you're a swing trader or a position trader, maybe you have different levels, whether it's a moving average or a percentage threshold that you're willing to withstand a pullback. But once you do get your signal, it really is important to take action. And I know when I started doing that, I felt not only a sense of relief and confidence in my trading, even if, it wasn't the perfect sell, because a lot of times it was a pretty good sell. It prevented me from, damaging my portfolio even more. And I think it goes both ways. So if you are trimming, when you do start seeing the signs of a pullback, it puts you in a much better space mentally to take advantage of those market turns to the upside and really press the gas when you do see those opportunities. And so whether it's 1998, I also think that 2023, that was another time period that reminds me of something that comes in handy, a little bit of a different setup in terms of the indexes. But what I wanted to talk about here is we did have a couple of failed follow-throughs, right? But I acted, right, incrementally and had to back away. And yeah, that's frustrating, but I think that's way better than the alternative of just going all in on that first signal and then holding and hoping for months and months and months. And then because I feel like that leads to poor decisions down the line if you're not in a good headspace.
Yeah, the markets are skewed to the upside, and from a risk reward. So the risk is, you can identify your risk. So you can get hit that 1%, 1%, 1% here. Let's say, I go down 8 or 9% off the highs off my account. But if I catch a big move, if the market goes on a really long trend, and the names that we're able to identify with the tools we have, yeah, they go up a lot more than the market. So I can go from down 9% to up 9% in a month or two easily. And then if it's really good, then I can start putting on more, and that's what gives you those really good years. So you're risking a little to potentially make a lot. And, you don't have to be right all that often. Like a baseball player, imagine a baseball player, if how often they're wrong. If
Yes,
you're if
batting
you
average.
bat
Yeah.
350, you're one of the best
Hall of
baseball players
Famer.
on the planet. Yeah, you're going to the Hall of Fame at 350. But that
Yeah.
means that you go back to the dugout 65% of the time, as having failed or lost. And
Yeah.
so it's the 35% of the time where they get on base, they steal second, they hit a triple, they double, they drive in 3 runs, et cetera, et cetera. So that's a
Yeah.
lot like investing. You're risking a little to make a lot, and you just got to kind of continue with that
Mhm.
mindset that when you're doing that, the odds are high that you're going to be wrong at least half the time, if not maybe slightly even more than half the time, maybe even 55, 60% of the time.